Welcome everyone to this month's monthly market update for August 2023. My name is Steve Latham and I'm the Chief Investment Officer for Bernanke Wealth Management. And this month we want to review the Fed's interest rate policy. Just a few short weeks ago, they increased the overnight interest rate by another 0.25%, which sets overnight interest rate to 5.25 to 5.5%. And a lot of people are thinking that that may be the ceiling. So we want to look at what we think could be coming up in the months ahead and what the Federal Reserve is going to be looking at in order to determine where interest rates should be going in the future. So to start, let's position ourselves with where we're at today. And by what you can see here on the chart in front of you, this is the current market odds for future interest rate hikes and or cuts. And so today, we are currently sitting right above this column here at 5.25 to 5.5%. That's the current overnight rate as set by the Federal Open Market Committee, or the FOMC, headed by Jerome Powell. Now, for the next meeting in September, we can see that there's currently an 81.5% chance that rates stay the same and an 18.5% chance that rates are increased by another 0.25%. So we're not taking another 0.25% completely off the table yet. It's possible that they could hike again, but it's relatively incremental considering where they've come over the last 18 months. Now going forward, we look to see in this March meeting in 2024 that the odds are for a 38.1% chance of an interest rate cut down to 5% to 5.25%, or said differently, a quarter point or 0.25% cut. So that would imply the market is suggesting the Federal Reserve is going to be hitting on some of their forecasts for where inflation is going and where unemployment is going to be. And so on that note, let's take a look to see where we're at today. So inflation is continuing to moderate, and the Fed's preferred measure of inflation is the Personal Consumption Expenditures Index, or PCE. And there's another component called Core PCE, which removes more volatile components of inflation, such as energy and food prices. So currently today, we have a headline PCE number at 2.79 or 97%, but that core PCE number, as represented by the orange line, still hangs up around 4.1%. Now, the Federal Reserve's forecast suggests that they expect that number to get down to 3.9% by the end of 2023. And on its current trajectory, it looks like it's going to hit that number by the end of 2023. Now, what does that mean for the Fed? That means they're going to revisit where their interest rate policy is and determine if it's still appropriate to be as restrictive as they are, given that they're starting to hit their inflation targets. Now, they obviously want inflation to get down to 2% in the long run, but they understand it's going to take a little bit of time to get there. So if they do hit that 3.9% core PCE number by the end of 2023, that would argue that they can start looking at interest rate cuts, which is where the market is forecasting. Looking at the jobs market, because the Federal Reserve has a dual mandate, inflation being one mandate and jobs being another mandate, we need to look to see where the employment picture stands today. So here in the chart in front of you, we have two different metrics. The first is the jobs opening metric, also known as the JOLTS metric. And currently, the amount of job openings in the country are just around 9.8 million job openings. Now that's still elevated, and the Federal Reserve views this as a tight labor market, which in some respects is good, but it doesn't help inflation because wage costs continue to increase. But it's still a healthy amount above where we were at in 2019, where was never really higher than 7.2 million jobs open for the United States public. Now that's just one component. The other component is unemployment. And currently the unemployment rate is down at 3.6%. Now the Federal Reserve also has a target for unemployment at the end of the year, and that's at 4.1%. So they're actually forecasting unemployment to get worse by the end of the year. And that would be in response to some of the tightening that they've done on the interest rate side of the equation. Now, if unemployment doesn't get to 4.1%, but inflation comes down below that 3.9% target, that would be another situation where the Federal Reserve would look and say, does the restrictive policy make sense today? And if that were the case at the end of 2023, it's likely that we're going to see those interest rate cuts start to happen. It doesn't mean that there's a recession coming along the way. In fact, if these metrics are hit, it's kind of the Goldilocks scenario that a lot of people are talking about these days. There's plenty of data left in the year for the Federal Reserve to look at and for the market to digest. So we're going to be keeping an eye on those metrics and many more through the end of 2023. But hopefully that gives you a little bit more clarity around what the Federal Reserve is doing and what the expectations are for the Federal Reserve and their interest rate campaign going into 2024. If you have any other questions, don't hesitate to reach out. We'd be always happy to answer them for you. Thank you.